everyone. This is Chrissy from Solstice ATR. Hope everybody's doing great. My handle on Twitter is Chrissy Farah. On Discord, it's ZOU pound 9345. And on YouTube, just my name itself. For illustration use, remember we're not a broker-dealer. Past performance doesn't indicate future results. This is for education. Use at your own risk, and data may not be copied. Before I do start, I want to go over basically like it brings me flashbacks of 2000, 2001, 2008, and 2020 is very similar in a different form due to the pandemic that happened, and the Federal Reserve Board globally and domestically have been, printing money at $1.2 billion a day, out in the market, keeping the market up. At the same time, we're going to look at volatility, the psychological and the psychology of how traders react to instant noise in the market. We're going to look if there's going to be a vaccine out very soon and the outcome of shutting down and coming back, reopening the economy. So before we do anything, I have a couple of ideas that I want to go over. I'm not going to go over them right now. I'll put them in my back burner till the end of the video so you guys can get a little bit of more taste to how basically whether you are a day trader or swing trader, be able to make money in this market. Okay, let's first of all start using the VIX. This is the electronically traded fund volatility index. There are the future, which is /VX, or the VXX for the banking sector. And if I look at the VIX from February 22nd, 19, all the way to March 23rd, we had a very nice high spike. And eventually we recovered and came back down because the market was able to get back to normal. But the S&P 500, if you look at the 500 companies, not all of them are performing similar to some of the tech and the biotech, and such as Amazon, Google, Netflix, Tesla, Microsoft, Nvidia, Lulu. I'm just naming some of the names that way you guys are familiar with them. Remember, some of them have made very well. Some of them are just sitting around hovering, not making much money due to the S&P 500. 35 to 40% of it is heavily weighted on those companies. So remember that things can change over time and the economy will come back, but there is a drawdown or a drawback up into the market as long as you understand the risk involved. This is why I'm showing the VIX. We had a bigger gap here. I'll show you on the weekly. I'll zoom in. We had it filled a portion of it. You can see between this candle and this candle, we had a nice gap. We filled a portion of it, so I had to move the cloud lower. I just did, create a box. And this is the low for basically the week that we had. In order for the VIX to continue higher, we're going to go to 15-day 78 and get a better idea. As you can see, we retested that low a week ago. We consolidated for a week and a half. In the last 5 days of range since Sunday, we came in. We looked to the low, came back up and bounced. We tried to clear the 25 area, but couldn't stay above it. This is very important. On the /VX, I have about 25, 70 cents, 56 cents to the upside. And to the downside, if we stay below there, the fear gauge is not there for us to worry about. So you have to keep an eye on the vaccine. And at the same time, we're going to keep an eye what the Federal Reserve Board and economy, if there's going to be checks going out as a relief because due to the shutdown, and restarting again. So as we can see, the highs and lows, I use a weekly fib. This is our 50%. The 61 and the 38 are very important. Do we stay above the 38 or do we fall below the 61.8 fib? This is very important to look at it that way. So that's how we look at the market overall volatility. What I want to do is right now go over the SPX plus the NDX plus the Russell RUT plus the Dow Jones Industrial Average as a combination of those fours. I will show you in the last week and a half, we've been range bound. We looked up on Monday, Tuesday. Unfortunately, we couldn't stay up. We fell down and all the indices on Wednesday. Thursday was an inside day. We fell on Friday in the overnight to come back inside the range of the prior 2 weeks. Does this mean that the market has a change possibility of a change in trend? Yes, it may have it, it may not. But the most important thing is to understand the structure. Are we going to stay above the 50 and the 61, or do we fall back in, or do we continue higher? Keep an eye what the technicals give you, not what you think. And this is why I use the shorter time frame instead of using the weekly or the monthly. If I go to the weekly chart, we'll just go once to the weekly and come back to the 15-minute or the like a longer time frame. We can see that the outcome when we rallied, we broke the prior highs. This is a very important area here. If I zoom in this area from here to here, this is the most important thing I will tell you. We are in an up channel. We eventually broke from this area, this one here and here, and we broke up. If we're going to fall back down, we have to keep an eye on this channel that we broke out of. Do we hold this upper channel and this channel to keep us continuing higher? There is a possibility of a 3, 4, 5, 6% drawdown in order to continue higher. So trade, once again, what you see, and this is why I show you the combination of those 4 instruments. If you don't have the tools to have more multiple screens when you are trading and you're swing trading, you can add those 4 indices together to see if the combination of those instruments are going to the upside, or there's divergence in between them, or are they coming back together to the downside. This will give you a hint as a general idea where the market is using those 4. Let's now take a look at the RTY. And now we're going to go down to, instead of the daily or the weekly, we can see that we broke out. We're in a linear regression. This was the prior highs, and eventually we broke out. We can put a channel here just to keep an eye on it. That way you are aware of it. And this is very important channel that we have to stay above. You can, connect it that way to here by doing an attachment. And this usually, those channels are very important if we stay above them or below them. If I go to a daily chart, we can see that on the daily chart that we added this area, the 100% retracement. We still have the extension, the 123. I kept it there. I have the monthly fibs here. If I go on the monthly, we have the extension. We tested the 123 to the upside, but we're still in the upper distribution, as you can see. And if I bring it down to a 15-day, 4-hour chart, we can see that we broke out of that consolidation in the last 2 weeks range, and eventually we broke up, came back in, but we're still in a symmetrical triangle. We are holding this channel up, and at the same time we're holding the 50 simple moving average. That's, some people use exponential moving average. They are a little bit more weighted to the shorter time frames because they will not, but they look at the last 10, 20 candles here. When they calculate on a simpler moving average or regular moving average, it calculates the wider range. So it is more smoother when they go up or come back down, for usually bounce off them, break away from them to the upside or to the downside. And this is the reason why I have the 50 simple instead of using an exponential 50. And we have the 18. Most people use the 20. I use an 18 because it's part of the Bollinger Bands or the Candler right in the middle, and that's why I use an 18 instead of a 20. So that's the 4-hour on the RTY. Let's take a look at now the YM, the Dow Joe. As you can see, the Dow Joe has been range bound in the last 3 weeks. It had a nice move down from Wednesday, Thursday, Friday, recovered, came back in the prior range. In order to continue, we have to clear the 50 Fibonacci here, the 61 coming back up in order to run. And we're going to keep an eye on this channel that we connected our dots. We broke this one, or you can grab this area here like a channel, and we can connect it to here, so you can see that we are in that channel up here. But this channel here that we broke away from, this is very important coming through, and we have one going down this way. What I usually do is I connect the dots, nearest high to the nearest low, or nearest low to the nearest high. That will give us an a better idea if we are going to break above or break away on either side of the channels. That's the Dow. Let's take a look at now the ES. As we can see in the ES, we consolidated, broke up. We were trying to look above on Tuesday, Monday, and eventually we fell back down Wednesday and came back. We retested the prior range from the week before. In order to continue, we have to clear the 38, 50, 61, and that's the 50 simple moving average in 18. We are in this down channel. In order to run, we have to break above here. I put these two channels here. If we fall below them, we look for the other side of the extension, which is the 50 and 61 to the downside. If we break above here, we'll look for the upside 100% retracement to the opposite side of the fence. Let's take a look now the NQ, the NASDAQ. NASDAQ was a little bit more weaker because remember the tech sector such as Tesla, Amazon, Google, Netflix, I'm not going to go through them, Melly, Nvidia, Roku, Lulu. I'm not going to go into all the details of those companies, but you have to trade the channels and the levels and using retracements of Fib. This is the weekly Fib on the NASDAQ from high to low, from Sunday to Friday. Every week we do that. The monthly is usually in purple. We take the monthly high and low of the November and we measure that to look where the extensions are to the upside or to the downside. And we are able to look at the moving average in relationship if we are pushing higher or lower. As you can see, the NASDAQ recuperated part of its move down. It stayed inside the Thursday's range, but we have not been able to clear the Wednesday move down. So the most important thing, that was a poor high when we fell down. We recovered part of the move back up, came back down in the overnight and pushed back inside the range. If we can clear the 38, 50, 61, this to the upside. If not, we look for the backside down here. So that's the NASDAQ. Let's take a look at the S&P 500. We'll do later on oil, gold, and Bitcoin. As you can see, we are in a linear regressions channel pointing higher. We fell back down in the prior range of the 2 weeks range, 3 weeks range. Similar situation, I anchored those back-end linear regression channels. We have the Fib for the weekly from high to low. And we have the monthly Fib. If we can clear the 50, 61, we look up. If we fall down, we look for the other side of the fence at the same time in the S&P. But remember, if there's a vaccine from Pfizer or Moderna or another company to help, the economy to go back and employers to go back online and people who choose to take it to keep, the virus away from us, things will recuperate. And we look at the transportation, we'll be able to look at the banking sectors in relationship to the bond market and what the stocks are doing in the 1,000 to 1,700 companies in the U.S. in order to help us out. So that's the S&P. Let's take a look at the CL. Crude eventually, this week it tried to break up. It stayed in the upper distribution from the prior, 3 weeks range where we looked up, we fell in, we went inside the range, and eventually we broke up on Thursday. And we fell down on Friday, but we stayed in the upper distribution. As long as we can hold the 50 and the 18 simple moving average and the 61 look higher. If it falls below the 46 or the 45, 82 cents or 90 cents, I wouldn't worry about it because this is the channel that we broke above. And you can see that this channel, I connected it from here to here, downtrending, and this is the breakout looking to the upside. So that's oil. Let's take a look at GC, which is gold. That's the different gauge where most people think, looking at inflation, gold has done nothing. People will say to me, why are you saying that in this video? Honestly, if you look at the overall, from 2000 till 2008, then 2020, gold has not done much. It goes up and down. On the short-term volatility, you make money, but on the long-term holding it, it's not going to make much money. And this is something that you have to recognize. I mean, we had a nice push on Monday due to the, currency war and all that stuff. Tuesday looked up. Wednesday fell down. Thursday was an inside lower day. Then on Friday, we're inside the Thursday and the lower distribution of Wednesday. In order for gold to run, it has to clear the 60 area, 68 in order to run up. If it falls through this channel, you look for the backside of the 1780, where, remember, I kept saying in the video, look for 1788, 1778, 1778. I don't know if anybody remembers it from a couple of weeks ago. I said, if we get in this range, please buy gold. You're going to have a nice rebound on it. And what did it do the following week? Take off to the 1860, 1850, and that was a good, nice run for you to hold for a couple of days gold on that move from Sunday all the way down to the Thursday, Friday range. So that's gold. Let's take a look at now BTC. And this is something I said to everybody, if we lose, the 19.2, watch out, put your stop at 18,600 if you're a very long-term swing trader in BTC. Take a look at BTC. Since we looked up at the 20,360, and this was my line for the monthly fib, we fell through it. And I said, hey, if you lose, the 19.2, be careful of it. It was range bound for 2 weeks. In this range week, then eventually we fell down. In order for BTC to continue higher, it has to clear the 18,623, 18,630 in order to run back up. If it cannot clear this area, it's still in a channeling down channel. You can see that big gap on that professional gap when I pushed it high, got everybody caught in the up range, then I brought it back into it. We haven't filled 100% of this gap. This is very important. Those two candle at the 17.7, 17, let's call it 550. If we hold this range, that's great. If it falls, it'll fill the gap. Then eventually we'll make a decision on which side BTC would be. So that's BTC. And I will show it if you guys like on a longer time frame so you can see it on a weekly 3-year. So you have a better outcome out of it. This was the prior annual high when BTC came on the exchange. It fell down to the 35. We looked at the 13. We were range bound between the 10 and 12, and eventually we broke up. We're still in that linear regression channel. If this is kind of get back up there, look for the 38.2 before continuing higher in BTC. So let's take a look at the AAPL. I'll do a couple of tech sectors. I'll just take the big companies and I'll just go over them on the short time frame. We'll use a 78-minute, 15 FA range. As you can see, Apple has been range bound in the last 2 weeks in that, linear regression channel and the symmetrical triangle. In order for Apple to clear, it has to clear the 23 to get back up to the 25 to continue to the 28. And if it falls through this channel, it'll end up in the 17. I'm looking to see if it can break out to the upside. That's Apple. Let's take a look at Amazon. Amazon is setting up in a linear regression down channel, has tested the prior lows. If it can consolidate and break up, we'll look for the channel up here where it's breaking out, continue to up here, and eventually to the prior breakdown here from that Wednesday range move. That's Amazon. Let's take a look at Google, and we'll look at Facebook. That's Google, okay. Okay, as you can see, Google has been, baselining in the last 2 days. This was the prior baseline. When it looked up, it went sideways, and eventually we fell down. If Google is going to make it up, it has to clear the 50% fib to the 61 in order to run up or look to the other side of the fence. That's Google. Let's take a look at Facebook. FB. FB is in a, as you can see, we have this channel, and I can do, a sharper one here, or like these three. If Facebook breaks above, that 277 area, look for the upside of this channel and eventually the upper area of the prior week consolidation. That's Facebook. Let's take a look at NFLX. Netflix has been range bound in the last, let's say 10 days. It looked up, came back in. It had the prior, consolidation here before it broke up, went sideways, broke up, came back into that range. As long as it holds, the 492, it's going to be okay. And if it clears the 505, look for the 61. And eventually, if we can break the 510, look for the upper side of the 517 area. That's Netflix. Let's take a look at Tesla. And Tesla, as you can see, because it's going to be added to the S&P 500, it's Elon Musk eventually became the wealthiest man next to Amazon and other. I'm not going to mention names. And this is really critical for me, taking a look at different companies such as Mercedes, Audi, Volkswagen, BMW, General Motors, Ford, Toyota, Honda. If I look at the other companies, some of them have good products, good things. But since it's the trend and it's an electric car, they think the other companies cannot do much better than Tesla. I think they do quite a bit of good things out there, for the economy and the consumer and the way the product looks compared to Tesla. I don't like Tesla for certain reasons, the quality of the vehicle. And, I'm not going to be biased. I mean, this is basically the Widowmaker that can, take people, all the way up to the moon, and it can take them down to the ground, on either side when people tried to short it or when people were trying, to long it and it was going down on them. So, and basically, since they got that stimulus always from the government, it helped them out in the long term. Even till now, I mean, they're not making money. It does not make sense. I mean, most of the money management firms and everybody holding that position, there's not much shares out there. And if they do a buyback, how many shares are going to go around? Not many to go. So unless, things do change, and, it's in a symmetrical triangle, as you can see. If it does hold the 585, should be okay to go up. If it breaks above the 530, look for the upside. If it goes below the 585 area, be careful of it. So you can either look for this range if it stays above it, or above this prior distribution where it looked up, came back in, looked above it, couldn't go anywhere on Thursday, and we fell inside the range of the Thursday range. If it can clear the Thursday's range, then look up. If it clears the prior week range and it falls, then we look for the other side of the fence. So trade what you see, not what you think. And I want to do two things before I told you. I want to look at the profile so you guys can see it, how it works in the S&P 500. Let's put the S&P 500 here, ES. And we're going to go on style. We're going to go use the monkey bars candles, and we're going to go to monkey bars. And this is the monkey bars in the overall, 15-day, 78-minute. As you can see, we fell down. And that Wednesday, we had a poor low here. If I look at the 10-day range, we just zoom in here. What I want to explain is this in the profile. Whenever you have a wick at the bottom or a wick up the top, the profile is clean. But if you have a flat bottom here, usually that flat bottom is usually going to be revisited, retested, in order to continue either up or clean the bottom or clean the top, to continue higher or fail from it. And as you can see on Thursday, we fell down. We came back to close here, and similar thing that we did. We opened at the high, we fell down and came back to close up in this area. So trade the charts in front of you. Usually the value area high is here, value area low is here, and that's the POC. And this is where the most time spent. If I take the volume profile, if we look at the most contracts where they were spent, that's where the green is, the value high is there, and the value area low is here. If we do not use the volume profile, we just use the most sentiment and time was spent in each instrument, then it does make a change on the way we look at the market. If I zoom in a little bit more, I want you to recognize it so you can see it. You can see that the range from high to low, that Wednesday it was a flat bottom. On Thursday we had both stops clean, and on Friday we had a nice, rounded area. We had two kind of distributions, one here and one here, and eventually we pushed up to close up in the upper. The POC shifted higher, and at the same time the time was spent up here. We just closed a little bit lower on that profile, and if I just go like this and just zoom in it, you'll see how clean it looks like. It gets bigger, and if I go to a 15-minute bar, you'll see the profile does change quite a bit. So you can see how the time was spent and the distribution of it, where it was you got one here, two here, three here, a little gap here where most of the time contracts were here. The time spent was here, as you can see, and up here. So this is how you use the profile in advantage to where we are at. This is the ticks. This is why I wanted to show the ticks here. And ticks up here shows us that the value area high was in this range Then on Wednesday, when we pushed lower, we had two ticks, to the downside, which is below 1,000. That's the pulse of the, the New York Stock Exchange to the downside, and the upside is here. We pushed to the upside, but on Tuesday, if there was a bearish tone, the breadth and the AD of the market would have continued lower, the volume would have spiked down, and we would have continued lower. But on Tuesday, we were range bound, and on Friday, we were in the same similar situation. And let's take a look at the VIX, which I showed you here. We looked at the highs on last month when we spiked up. We came back down. We're trying to stay up, but if you can see here, as long as we are below the 25-20 area, we're still going to be okay. The last but not least, this is the breadth of the market. If we take a look at from 1982 till 2020, it reminds me of the 2000 time till 2003 when we had, the technology, then the Twin Towers, then we recuperated in 2003. Those bottoms are usually very hard to recognize them. Most people don't recognize them. Here, I was a kid. I don't remember, the 87. I was a young, bachelor, didn't know much. In 1990, I didn't know any better either. So, and we had those moves up. We came down, we pushed up. This is the only scenario from 2003 and 2008, 2009 when we fell down. We came back 100% of that move. From 2009 till 2018, we had the little glitch here due to the tariff in European zone here in 2016 and stuff, because of the British exit and the French elections. Then we had the COVID-19 right here. We had a very dramatic push lower, and eventually we recuperated because the Federal Reserve Board, what are they doing? Printing more money. The global markets are trying, to get things back going on the right side. If there is a drawdown in the market, we do expect, we can see, 35, 50, 3,500, and even 3350, if we're going to lose 2%, 3%, 4%, 5%. But the overall market has been, pushed on daily basis to the upside. If you look at the outcome, in 2 years, 3 years, 4 years, 5 years for people who are swing trading, the returns can, over 78% average. But if you look at the short time frame, the draw up and the drawdown, 21%, and we can have, a negative year. You can see the 1991, in 6 months, and you can see the 1988, the drawdown here is 3%. So let's go over one more. Here I'm showing how far are we away from the 200 MA, simple moving average, or you can use the exponential. I rather put my weight on the moving average to simple. As we can see, the S&P away from the 200 SMA from 2003, 2009, 2013. The 3 months draw is about 3%. 6 months is an average of 3. 1 year and to 4 year range, we have a 47% rate of return. The NASDAQ is a similar situation. We have a drawdown, in the first 6 months, from all the way from 0 down to 3-4%. But the outcome in 4 years, an average of 37%. This is the breadth and the momentum indicator for the NASDAQ New York Stock Exchange. If we take a look at the overall S&P 500, which I showed you earlier, this is the drawdown, and this is the New York Stock Exchange, the drawdown from 1997 till 2009. What can be, the drawdown in 1 month to 3 months. This is why I'm saying we can have a negative pullback in order to continue higher. So we're going to trade what we see, not what we think. I hope this was helpful. Let's go back to the charts. Put the S&P 500 in front of us. Go to standard. It goes back to candle. And here's, as we can see, we are in that linear regression channel. There's a midpoint here. In order to run, above it and, clear, we got to see if we can clear the 61A in order to run up. If we cannot, and that 50 SMA and the 50 stands in front of us in the 61, and we come back down to look for the other side of the fence. So I hope this was helpful. I look forward to seeing you at Solstice ATR or Discord. Over and out.